All right, so I'm going to pull up this 10-year, 2-year chart. This is the 10-year U.S. Treasury bond and 2-year U.S. Treasury bond, and you can see it's an inverse correlation to recently to the S&P 500. So lately, the tail is wagging the dog, as they say. The bond market is kind of determining what the stock market's doing. So I'm going to do a quick check on the 2-year and the 10-year. So the 2-year is going up, and the 10-year is going down. So usually they go up together. So that's probably why the stock market's kind of wishy-washy today. It's kind of going up and going down. It's kind of flat right now. But whenever 2-year is up and the 10-year is up, the stock market's down. That's the correlation we've been seeing. So basically the lesson learned with all this is that depending on the current interest rates, what is the rates of the treasuries, people pay less or more for stocks. That's the good lesson learned. So we know, let's look. Okay, so we know this is a chart of interest rates in America over the last, since 1950. And you can see how whenever rates are really low, the people pay more for the stock market. Whenever the rates are high, people pay less for the stock market. The S&P. So the red is the S&P, and the blue is the S&P, red is the 10-year. So basically what this tells us is what people are willing to pay for the S&P over time. Actually, the S&P minus the top 10 stocks are trading at a PE of 15 right now. So that's pretty fairly valued. The only things that are overvalued right now, for the most part, in the S&P are the top 10 big tech stocks. All right, let's look at where we are in the calendar. Returns. These are stock market returns since 1980. And if you go back to 1929, it's a very similar pattern. This is the best month of the year. And the last 3 months of the year are the best months. So there's a seasonality that tells us we're probably going to be, when in doubt, going up versus going down. So that's why I listed, green for around the holidays. We have a holiday next week, so usually around holidays, the stock market goes up. But we're in a position right now where we're overbought. We were overbought last week, and this week we're 97. It was 95 last week. So whenever the stochastics are really high like this, that's an indication that we're overbought, and that doesn't mean we can't go higher. It seems like we've been in a pattern in the S&P to making higher highs, higher lows since the beginning of the year. And we're staying within this channel. We went down just a little bit out of that channel, and we broke through, and we're probably going to go back up to here. And so our pattern is higher highs, higher lows. It's going to get hit here, maybe, and hit here. So we're going to do maybe a zigzag towards the end of the year. So that's the reason why we keep track of these things is if you're not invested in the stock market, you got to put your money in slowly but surely. And usually whenever the stock market sells off and where the stochastics are really low, like here, here, and here, that's the time when you want to start putting money in. So right now, this is the time when everyone is actually starting to get really excited about the stock market. So this is the time when, if you're new to the investing, this is the time that you would try to pile in. It's going up, everything's going up, everything's back to normal. It's just whenever that happens, if we look at investor psychology, here it is right here. Well, right now, we're getting into this enthusiasm, media attention phase. So we're actually right here right now. We just turned from fear to neutral today. So we're probably going to be getting into greed as the stock market goes up. And this is a time when, for me, I just watch. I'm just going to watch it. I'm not going to, if I have something to sell, I'll start selling some. But this is basically the time when everyone gets excited. We're starting to have momentum come into market. Now let's look at some of our things that are coming up on our calendar. First of all, we have Thanksgiving, and people get excited right around the week of Thanksgiving. They're getting time off, and they feel good. We have two holidays, Christmas and New Year's, right jam-packed close to each other. So usually that the week before, the week after, around that time is a good time of the year. We had several indications from Jeffrey Gundlach that we're going to have a recession in January, February. If you look at the recessions that have been in America for the past 100 years, they last like maybe 2 months, and then we're out of it almost immediately because the Fed tries to get us out of the recession. And that's why I list the next March and April as better months. And also see sometimes there's some theories of why some of these markets move the way they do. Like, why is it February is a bad month, and why is it June is a bad month? Why is August, September? Sometimes it could be because of weather in the Northeast, where majority of traders are. Because whenever there's better weather, people feel better and they trade stocks higher. But we don't know. We just know it happens. It's something we have to keep in mind. It's a variable for us. Okay, what are things we have to keep in mind? We have to keep in mind, come January, we also have earnings coming out again. So we just finished our earnings and for this month. And we have to wait for a while for earnings to come out again. Okay, let's look at some of our notes. The 10-year and the 2-year are down. So it's down around 3.5% in the last week. And if we look at our chart for inverse correlations, when the 2-year and 10 years are down, the S&P goes up. So that's what happened this week. We had a rally in the stock market. So that let's go back to our notes here. Okay. All right. So right now, let's see. Here's some more talking points. It's the best time of the year, seasonality-wise. We're starting to get market breadth back. This is called momentum. Whenever we have momentum, there's a chart link in our meeting notes I'll send to you. You click this link, it'll tell you how many S&P stocks are above the 50-day moving average and the 200-day moving average, and that's getting higher. So it's above 50. That's an indication we're starting to get momentum, and that could lead us to good times in the next month or two. In the next month, probably. All right. So we have corporate buybacks. Okay, there's like at the end of the year, December, there's a lot of companies that buy back stock, and that adds to upward pressure in the stock market. And the U.S. dollar is actually going down now. It's actually in a downtrend. Let's look at that. Because as that U.S. dollar goes down, that's good for stocks. So we're rooting for the dollar to go down because that makes the companies that do business overseas more profitable. Okay, so these are all the variables we're looking at. And fear and greed. Look at this. We were in fear for the last 2 months, 3 months. We finally are transitioning into greed and extreme greed. And that combination is momentum, and that allows stocks to go higher when none of the fundamentals are changing. So there's a good indication. We talked about last week, we talked about this 90% down day. What that is, whenever 90% of the stocks go down, 10% go up. And when that's preceded by 80% up days for a series of days, like a couple days in a row of 80% or plus or more of up days, that's called a breadth thrust. And that combination usually leads to better times later on. I mean, it usually tells you your stock market's going to go up. So we have some good, and we have seasonality on our side, a lot of things that are happening, and we're overbought. So for me, I'm like not touching anything because I know it's people are getting excited here, and you don't want to like chase momentum, but that's what's happening. Okay, so let's look at some of our meeting notes. Okay, the VIX is actually going down. That's because people are not buying protection. They are less fearful, and that's a contrary to the stock market going up usually. And we're oversold with that. That means that people are not afraid and people are starting to buy. So if we look at our Yahoo Finance today, it's kind of break even. It's most likely because we have that 2-year and 10-year kind of telling us one's going up, one's going down. We don't know which way rates are going today. So that's probably why that's happening. We don't have any earnings reports today. Let's look at some of the market movers that are going. We have a lot of retail stocks going up today. These are all stocks that have very high PE ratios. We have oil stocks going up. Oil must have gone up today. Look at this. Okay. Look at the price of oil. See what that is today. Commodities. Oil up what? That is just an amazing amount. I don't know why it's up 4%. Maybe there's some kind of news about maybe a war or something. But that's obviously making the U.S., all these oil stocks follow. That's why the oil is in the top 10. One's going down the most. I don't see any. We have Alphabet going down 1.8%. It's been on a run recently. Let's look at the stochastics of Google. It is probably the most overbought stock that we're following. And it's super. Let's look at it. Google Alphabet. There it is. Okay, so if we look at the chart, we have the having an upward channel here. We're at absolute top of our stochastics. So we have a ways to go before Google gets back down to here. So it's still reliably in this channel, Google. And looks like recently it's been falling into this sideways channel. Maybe that's because there's a antitrust case going on right now. People don't want to commit to it until that's over. I think it's almost over. So as soon as that is over and it's good for Google, it'll probably go up to here. If it's bad for Google, it'll probably go down to here. So that's interesting. We're overbought on most of the stocks we're following right now. So it's a super bad time to buy stock.
So your question on oil is that it was down the last few days.
Oh,
it's recovering back up to an earlier price.
It's very strange for it to be up 4% in a day.
Yeah,
really.
It dropped like 4% yesterday.
Oh, yeah, that's probably why. Okay. Well, we can't predict the price of oil. That's why it's so hard to buy oil stocks. I mean, because if the price of oil goes down, they're not going to be profitable. If it goes up, they're going to be wildly profitable. So whenever you buy a stock like an oil company, you just have to be willing to go up and down with the price of oil. And there's people, I'm sure, that there's companies, there are countries that manipulate the price of oil. But we can't do anything about that. And that's why I don't have a whole lot of conviction in oil stocks, because even when you found a great company that uses its capital well and everything, the price of oil goes down, then you don't know what's going to happen to the price of the stock. Okay, so let's look at some of the S&P, the NASDAQ stocks going up and down, pretty much the same. So we have Microsoft, Apple, Alphabet. They basically held up the best so far this year. So I guess they're just taking taking a little bit of profits today. Let's look at the ones in the Dow. A lot of jug stocks going down today. Wonder why. They're doing some, the government is actually making some kind of deal with Medicare where you have to bargain your prices. So all the stocks that the top selling drugs have to take less if they want to sell to Medicare. So they're right in the middle of bargaining that. That's probably why they're down so much. Warren Buffett just sold out of Johnson & Johnson. And maybe a lot of times whenever the quarterly information comes out for mutual funds and stocks, whenever Warren Buffett or Berkshire Hathaway sells out of a certain stock, then people follow that. So let's look at some more talking points. Okay, so I found this article. I'm not part of Jim Cramer's stock club, but I found a very cool article that listed all of his stocks in his charitable trust. And I listed that link here. And so I thought it'd be interesting to go over, this is as of August, so it's not right now, but he usually buys and holds stocks. So I'm sure a lot of these are the same as what he's doing right now. But let's look at some of the stocks that have done really good and ones that have done really bad. So at least all of them are positive. Most of these are positive. He started talking about Eli Lilly like 2 years ago, so he was definitely right. He was initially interested in it because of the Alzheimer's drug, not because of the weight loss drug, but that just came up within the last half a year or so. He's been talking about NVIDIA for a while, about AI and how they have an advantage with that. And I think some of the stocks that he has in here don't make a whole lot of sense. I did some just some analysis of. Let me see, where is it? Here it is. Here's one of his stocks. Win is a gaming stock. So they have some places in Macau, a couple other places. I don't understand why he bought this stock. We have a bunch of negative quarters, of course, for the pandemic. They shut all the casinos down. But you see, this is pretty inconsistent earnings, in future earnings. We have a negative earnings growth between 25 and 26. So, you can be a part of this club, but you have to really do your due diligence to make sure it makes sense. And I don't know, this PE of this stock. Let's look at the PE of Wynn Resorts, RATS. PE is 300. That is the highest PE I know of any stock that I'm following right now. And it's not even growing. So it's a really strange one, and it's been one of his worst picks. So I'm just saying, whenever you see like Jim Cramer's club, you got to really make sure that these make sense and you do your homework for each one of them. Let me see. Let's look at another one he has here, Ford. That's in his charitable trust. Ford has a problem right now where they can't control their input costs. They have UAW, United Auto Workers, that are demanding more and more money every year, every time they have a contract problem. They have a PE of 6. That's a really low PE. But the earnings, they're flat. They're not growing. If you divide these year by year, it's like no growth between now and 3 years from now. So I don't think that one's a good one either for his picks. So I think we can do a deep dive in some of these other ones. Half of these stocks are the ones we follow anyways. But the other ones that we don't follow, I just can't understand a whole lot. All right, so let's look at Jim Cramer's portfolio and how. What I did was I put all these stocks that he has in his portfolio into sectors. And this is a little talk about how to make a diversified portfolio of stocks. And I'm giving his portfolio as an example. So basically, the reason why you can't put all your money in one stock or two stocks is because sectors go in and out of favor every year. So there's a chart. It's called the annual S&P sector performance. It's updated as of last year, which is pretty good in year to date. You can see the how different sectors perform better or worse. You know, this S&P is up 13% this year. Last year was down 18%. So in my portfolio, you know, I try to balance things out as best I can. I had some big tech stocks in my portfolio, and I'm trying to, over time, diversify out of that and into more of a well-balanced portfolio. So this is an example of how telecom stocks are up 40% this year. Financials, minus 7%, 1.7%. But last year, when, let's see, healthcare was minus 4% this year, minus 4% last year, but it was 26% up 2021. So when you're putting together a portfolio of stocks, you have to understand before you buy it what sector it's in, and then you have to say, well, what percentage of that is my portfolio? So let's look at some of these sector indexes and best, worst, and annual averages. This gives you an idea of what kind of stocks that you want to be in general. So for me, over half of my stocks are in information technology or technology. So annualized, that returns like 13%. And I've chosen that because I want the highest returns in my portfolio. But I do have like 10 or 15% of healthcare, which returns like 11%. And other ones I have. So I have some consumer staples. So you can see, you know, if you choose to have utilities in your portfolio, you're only going to get over time 7%. So you have to be willing, but it's a little more secure. So the reason I'm doing this is we're going to take Jim Cramer's stocks that he listed in his charitable trust. We're going to try to put them in those categories and see how diversified his portfolio is. All right, let's go look. Okay, so his portfolio is pretty heavy tech stocks. So you can see Apple, Salesforce, Alphabet, Meta. These are all the big tech stocks. And then you have two banks, consumer discretionary. For someone who preaches on the TV diversification, this is kind of lopsided, if you ask me. I guess you could maybe carve out some of these like Qualcomm and NVIDIA as maybe semiconductor stocks. You know, you have two semiconductors, and then you have some software companies, and maybe Apple can be considered retail. But in general, you have technology stocks, like more than half of his portfolio. 1/3 is tech stocks. But you can see how he has a little bit of each one of these sectors. And that actually, whenever one sector goes down, like in this, whenever one sector, let's see what tech is up. This, okay, when one sector is up, the other sector is down. That's how you diversify, and that's how over time, I'm trying to get a 12% return. I've gotten like a 12 to 13% return every year for like 13 years or so. So I have like this set of stocks that are kind of hovering around information technology, healthcare, and consumer discretionary and staples. I didn't really look at this chart when I was putting that together, but I map out the growth rates for the stocks, and I try to get the best, most reliable return over time. So, is there any questions about that? Right. Okay, there's, I was saying this is the time of the year when mutual funds, stocks like Berkshire Hathaway, and hedge funds have to submit, I think it's 13F, some kind of official form to the government of what they own. And okay, there is an article that Berkshire Hathaway reduced or removed several stocks from their portfolio. And what I'm going to do is I'm going to go over each one of these and figure out why he got rid of them. I mean, these are pretty long-term holdings. He's held these for like a super long time. He bought Gillette, Procter & Gamble, like 20 years ago, and he held it until recently. So what I'm going to do is I'm going to go through each one of these and say, well, why doesn't it match Warren Buffett's techniques anymore? Why would he sell it? General Motors, that's in the news recently for their strikes. I mean, the people that make their cars are in the union, and they have to demand 20% more every year. So you don't know how much you can't predict how much money they're going to make every year anymore, because that's at the mercy of the United Auto Workers. That's one bad thing about it. Second bad thing is, I don't think they can make a profitable EV car, and in 10 or 20 years, all cars are going to be EVs. So with Tesla undercutting the prices, it's like super competitive, and I'm not sure. That's probably why Warren Buffett reduced to nothing their holdings in General Motors. On top of that, let's look at GM's earnings estimates. Okay, I like to see a straight line here. I like to see 7, 8, 9, 10. It's going down. It's going down this year to next year. Then it's flat, and then it's up a little bit. I don't know why it's up a little bit the next year after that. But you can see how unpredictable this stock is becoming. And you see, I don't know, it's becoming, it has a very low PE, a PE of 4. All the most car companies have very low PEs because they're not growing very much. So that's really, so this is a lot like Ford, where Ford isn't growing either. And they have the same problem where it's all flat earnings growth over the next couple of years. So I guess the only reason people would own this is for a dividend. But that would explain why Warren Buffett would not be interested in this one. Okay, let's look at another one, United Parcel Service, UPS. Let's look at why would he sell out of this one? This seems like a very consistent growing company. They have a duopoly with FedEx and the United States Post Office, I guess. So it's not a lot and Amazon is kind of starting to muscle in their way for deliveries. So let's look at UPS's earnings estimates. If you look at that, that's pretty decent. They're growing. I did the numbers during the pandemic. I mean, they're growing around 10% right now, going forward. So if they're growing at 10%, if you divide this by this, and then this by this, you'll get 10%. So the PEG ratio is 1.5. But why would it's not, instead of growing, they're a little bit expensive. Maybe that's why he sold it. And maybe why would Warren Buffett sell this? Probably has something better to put it in. A lot of times whenever you find a stock that's a little more consistent and has a better potential of long-term growth, maybe because Amazon is kind of getting into the delivery business too. I'm not sure, but that's kind of my understanding for UPS. Johnson & Johnson, we've been talking about this one also for a while. The biggest problem with the Johnson & Johnson is they have talcum powder lawsuits, billion-dollar settlements, and we don't know when that's ever going to end. And I stay away anytime there's a possibility that a company can go bankrupt. I mean, there's a good possibility. They're trying to spin off some kind of company to take the blame for this, but it's not working so far. And I guess Warren Buffett can't see that predictable company that's going to be around in 10, 20 years. That's the problem with Johnson & Johnson. They might be out of business if the telecom powder puts them out of business. Let's look at their earnings estimates too. Okay, going this year to next year, that's only 7% growth. From 24 to 25, that's only 4%, and then 3% growth. So it's starting to decelerate. The growth is decelerating, maybe because they're spending so much on the legal stuff. They're fighting lawsuits, and that reduces their profitability. So the PEG ratio, they have a PE of 30. That's just amazingly high, and they're only growing at 4%. So their PEG ratio is like 8. So it's not growing. It has potential to go out of business. And it's like they call it dead money. It could be the same price in 10 years, and you get a dividend, and that's it. That's kind of what that's called. Maybe that's why he got rid of Johnson & Johnson. Procter & Gamble, this is one we follow. He got rid of his entire position of that. That's surprising, because he bought this like 20 years ago when he bought Gillette. And it wasn't a direct purchase. He bought Gillette, and Gillette was bought by Procter & Gamble. Then he got stuck with Procter & Gamble. So maybe after all this time, let's look at what Procter & Gamble. So the theme with Procter & Gamble is they're trying to reduce the number of products that they have and advertise more to get a bigger market share for that type of company. So for instance, that product. For instance, if you have, I think they owned CoverGirl or something like that. And they sold off that because that didn't have a high profit margin. But they put more into advertising for Tide. So that's their strategy. And it seems like if you divide their earnings estimates, they're growing around 8% a year. That's not bad because they have a 3% dividend. So that's like 11% total return. That's why I'm still holding this. I still see just 11% total return over time. But it's really expensive. It's 3.75 PEG ratio. And it's 30 PE. So you can see with the earnings here, they're really reliable. You don't see any negative quarters. It's very predictable. I would expect Warren Buffett to hold this one. I don't know why he would sell it though. This is the strangest one because it's so predictable. They have a product that's easily understandable. That's what Warren Buffett likes. Razors, people are going to use razors 20 years from now. But he did sell out of it. So that's one of the exercises we'll have to figure out someday. There's someone who will talk about it, I'm sure. We'll figure that out. But I'm still holding it because I see it growing at 8%, and it's yielding a 3% return too. 3% dividend. All right, so let me see. Is there any more? Mondelez. Okay. Mondelez is a snack company. They make like Keebler cookies, and they were spun off from Kraft, which Warren Buffett owned. So they might be selling this because he never actually bought this. It was a spinoff, and there's been talk recently about weight loss drugs and how maybe people aren't going to buy snack foods anymore if they're not going to be hungry after, I don't know. That could be a reason why he sold out of this one. Let's look at the numbers on Mondelez. They have very consistent 8% growth. I'm surprised Warren Buffett would sell out of this one. It has a dividend and it has a 8% consistent growth. The PE is 21, so it's pretty expensive. Maybe Warren Buffett found something cheaper that returned more. So it's pretty expensive. That's probably why he probably got rid of it. It looks pretty reliable though. So, right. So I thought that was an interesting little diversion, of how to put together a portfolio. I guess next week what we can do is we can actually take some of the stocks we're following and try to put together a portfolio for different money levels and different situations. But right now, what we'll do is I'm going to show you how to use this investing spreadsheet, because I update this every every week. It basically tells you, it basically calculates how much money's going to be worth, your money's going to be worth if you invest it now, which is pretty powerful. I've used this technique for a long time, and it's worked out pretty good. So I have in this chart, in this chart I have several things that are updated on a regular basis. The yield and growth rate, these are used in calculations. So if you start with 100 shares of a stock and it's currently trading at 138, the total value of that, total stock price of that right now is this much. But if it's on sale or if it's overvalued, then this is what its total value is. So what I do is I multiply this total cost, I add the yield of 3.8%, then I multiply that growth rate, and then you see how much money you're going to have at the end of every year for that small investment. So it's a very simple calculation. You add in the yield that you get and the growth that you get. So if it's 13% on $1,000, that's $130 a year you get. So I do this because this allows me to figure out how much I'm going to have over a period of time. So let's start off with this. This is how much it's worth this year. And I tabulate it way at the bottom here. If you add up all the values of all of your stocks, this is how much it's currently worth. Next year it'll be worth this much, and the year after it'll be worth that much. And that's pretty powerful when you're trying to plan your retirement or trying to plan how much money that you want to have for certain. If you want to buy a house, you want to buy $1 million house, well, it'll take 2 years, or whatever. And the tricky part about this is going over the news every day. I look at the news every day because this is pretty important to me. And I try to make sure that these yields and this growth rate are accurate. If you see a news story that gives you a hint that, the growth isn't going to be 13% for Avi or another company, then you have to make some changes to your portfolio. Like if Google is not going to grow anymore, it's zero, I got to scale into some other ones that are yielding, they're reliable. So whenever I'm looking at a portfolio, some of the important things, I'm pulling up a list of some of my stocks. Whenever I buy a stock, I have in my mind a confidence level in that stock. And there is no number out there you can get on Yahoo Finance or anything. It's just something that you have to know after investing for a long time. How reliable is this going to be? Sometimes it's looking at Warren Buffett's holdings and he's still holding it, But in your mind, you got to have a confidence level. And based on your confidence level, you have to put a certain percent of your money into different investments. And the higher conviction that you have in your ideas, the bigger percentage you have in your portfolio for that stock. And so that's why I bought a lot of these like 10 or 15 years ago. And I do my homework all the time just to make sure it's still growing and my confidence level is still, 100% in the stock. And sometimes whenever you have, I'll give you an example of Eli Lilly. I didn't update this percentages, but I think a year and a half ago or so, I said I'm going to force myself to diversify into Eli Lilly because I don't have a whole lot of drugs in my portfolio. I've been talking with you off and on about that for like a year now, and I've actually, it's gone up 70% this year. So this is actually turning into like a 5 or 6% part of my portfolio now. And at that time, I had like a 90% view. I thought it was pretty reliable. And you see, so I'm a little bit heavy in my top heavy in my portfolio. Like these top three are like half my portfolio. That's not good practice. But if you're in a situation where you have a high amount of capital gains in your portfolio, you have to be willing to not sell. Otherwise, you take like a huge tax problems. You have tax problems. So anyways, I've chosen to hold them because they're still growing, even if they're growing at 5%. Like Apple's growing like maybe 2 or 3% now, not much at all, or 0%. But they're every 6 years they do come out with a new product. Google's growing like 15%. Microsoft is like 15%. So I'm still. You have to keep in mind what that confidence level is, and if it's 25%, you don't have a whole lot of confidence, but you have some, starting positions. Some of the starting positions that end up turning into bigger ones. I put a lot of whenever I have a stock that comes up that I like, but I don't want to put a whole lot into it. I do a starting position, and that's like maybe 0.5% or 0.3%. And as it goes down, I buy a little bit more. And that's what I've been doing. That's why I have so many really small position 1% starter positions. But my portfolio, what I'm doing right now is over time, this 21% in Apple is going to go down to like maybe next year it'll be 20%, the year after it'll be 19%, and then I'll be putting more into companies that are more diversified. So if we look at this, where is it? This right here. Right now, like half my portfolio is in tech stocks, but I'm going to have to diversify, into different sectors over time to be more balanced. And that comes with you when you grow older, you have to put more of your money into more conservative things. So I haven't done that yet, but that's on my list of things to do. I thought that'd be pretty interesting to go over that. Does anyone have any questions on any of this? Okay, so I see we have a lot of new people here. I'm going to go over a couple. I know this for you that come every week. I know it's just kind of boring, but it's worth it because it's basically my strategy of how I invest, and it's worked for me. I've gotten like 12, 13% a year regularly, and it's working pretty good. So whenever I'm doing my research, I try to follow these variables whenever you're looking at stock market, when you're looking at stocks to buy. So let's look at a stock like Google right now. Looking at it, example of a stock that follows a lot of these. Okay, so right now you get a summary. You get from here, you get a PE ratio, which is 26. That's pretty high. Let's look at the statistics for Google. Okay, so Yahoo Finance has most of the statistics we need to research stocks. All this total debt, return on equity, profit margin, market cap, forward PE, growth rate, PEG ratio. That's all in Yahoo Finance under statistics. So if you see market cap, PE, forward PE is 20, PEG ratio is 1.31. That we know just by looking at PEG ratio that this is nearly fairly valued. It's about 30% overvalued. And we can see profit margin is 22, and we have return on equity of 25. So what I do with my stocks, I make sure that stocks that I have return on equity. These are my formulas here. Return on equity greater than 12. Profit margin greater than 12. Market cap has to be a bigger company, over 50 billion. Forward PE, it has to be low compared to the growth rate. So for Google, the PE ratio is 20. The growth rate is around 15. So it's just a little bit, 30% overvalued. That's an example of how we can match that. And PEG ratio tells you how much overvalued it is. So if it's 1.3, like Google, it's 30% overvalued. If it's 1.0, it's fairly valued. So another important thing is high free cash flow. You can look at the bottom of this Yahoo Finance for the cash flow statement. It's 100 billion. Google is very profitable, and that's what the high free cash flow. Okay, so company has a competitive edge. They have 90% market share in search around the world. So that's a good competitive edge. They might lose it with the current antitrust lawsuit, which is a big problem. They don't have a dividend. Very transparent, predictable, growing earning streams. You can look at E-Trade, with just $50, you can open an E-Trade account, and you can get all this great research. I have like maybe $100 in this one. So you can see if we do a search on Google, take a while. You can do earnings. You see the P is 26, the 4P is 20, and you can see they're growing at 15% a year. And that's but if there's something that comes out with the government where they force them to break up, all this is blown up and we can't count on it anymore. But that doesn't happen, and they've been saying that for 20 years now. So that's an example of how I do my research. And I go on Fidelity. They have a good stock screener. I come up with my list, and I look at Jim Cramer stocks. Maybe next week we can go over some of Jim Cramer stocks. We'll go over these stocks that we're not currently following, see if they have any credence, see if there's something in there. I've been through them a couple times. I didn't see any that match my formulas. Some of them are totally way off, like Wynn and Ford. They're not even growing. I'm not sure why he's interested in these. So, okay, let's go back towards my theories of investing here. So the key to my investing is I buy and hold. So the key is that you can't get scared out of the market. You got to follow news stories regularly so that you're not scared off by someone on TV or a news article. And every news article that comes out, you got to say, does that affect this stock 10, 20 years from now? And for the most part, when there's sell-offs, the big tech stocks pretty much aren't affected. I mean, they have enough money where they don't have to borrow money, and they also have a business product mix that is robust, that'll get by almost any situation. So I thought that was pretty interesting to go through that. This is like how to determine a good growth stock. And I'm pretty good at buying growth stocks. I've been doing that like for 15 years now. So you see. So you can see this is Yahoo Finance. All this lists. This is in my meeting notes. You'll get. So this lists all the places in that statistics part that I look at. It's not the only thing. The other thing, as we talked about last week, is debt. The debt compared to the market cap. When the interest rates go up, those companies that are borrowing money, and it shows that they have debt here, they're going to be affected negatively. And this lists the dividend right here. So I thought that was pretty important. This is a little example of bull and bear markets. It's also kind of similar to the recessions. There's not that many recessions in American history the last 100 years. The recessions are like a very small portion, and the expansion times are much greater. So a lot of people the average investor might be, they might want to sell out during the bad times so they don't lose money. But if you sell out, you don't know when you're going to get back in, and then you might miss this whole expansionary time. And so the way it works with the Federal Reserve, when we have an a time when the economy is expanding, the Fed at this point in time starts increasing interest rates. And whenever it gets so bad, we're in a contraction time, like a recession, the Fed actually starts cutting rates. And when they cut rates so much, companies get to borrow more money for less. And that allows an expansionary time. And then at the end of that expansionary time, the Fed sees it's heating up, then they raise interest rates again. So we just went through. We're at this point in time right here. We had some expansion, we're overbought, and we're ready to go through maybe 2 months of a recession. And for me, I bought these stocks like 12, 15 years ago. I'm not going to sell those stocks and have to pay 20%. 20% you lose of your investment if you sell, just for the small little time. And we know from smart people that are telling us, that there's a recession around the corner. And if that happens, it's just a blip, in the big picture. You have, there's another thing that says volatility is the toll we pay to invest. For an adult investor, you got to be willing to see the stock market go down 3% 7 times a year. And if you have a 5% correction, that happens on average 3 times a year. But if you buy and leave your money in the stocks over a 10-year period, it's like a 90% chance it'll be up. But if you go to a gambling place and you put your money in the slot machine, the longer you're there, the better chance of you losing. It's a little bit different than the stock market, the gambling in the casinos. So, but you got to expect these recessions, and we're right in a position where people are excited, people are in that graph, that emotional graph, we're super excited, people are starting to get bullish from fearful, and you got to be willing to sit through these bad times. And I'm used to it now, but it took me a while to be able to understand, the nature of these sell-offs. It's more of there are babies that are thrown out with the bathwater, and you got to be used to that. And know that there's ways that we have like this to calculate how much stocks are really worth. And sometimes they're undervalued. Right now, Apple is like super overvalued, but I'm still holding it because it's growing 8% a year, and it's not over time. So I know there are times when it's overvalued and undervalued, so you just have to be willing to put up with that if you want to have a buy and hold portfolio. Okay, so here's some stocks that Jim Cramer says. I'm talking about itself all the time because this is one thing that could totally throw off your portfolio if you get caught up in the stocks going down and you're stuck with a position that's pretty top heavy or something. The first indication is to sell off, it's to sell everything. But really, what you want to do is start looking for companies with big moats that have even in good times and bad times, they still have a product that's going to be used and sold 20 years from now. So I just want to look at some of these just real quick. Microsoft, they have a monopoly in Windows. They're going to be selling antivirus. They're going to be selling add-ons to their Office, like cloud. You can back up your computer. They're going to be doing that forever. And that's like a natural monopoly, and they're going to get away with that, it seems. But in 20 years, where would they be? They're AI. I mean, right now they're going into AI. So you're going to have a bot that you can ask questions to on your phone or your watch. So I can see the future of Microsoft is pretty good. That's a wide, and they have business customers too, and gaming customers. They have a lot of big, diverse product line. WM, Waste Management, they have a duopoly with Republic Services, and they're making money. Their theme is they're making money in recyclable. They're making money with energy. The landmines are making gas. So if they keep doing that, they'll have a multiple revenue streams, and they keep increasing their trash usage with the economy. That's a good business model there, for instance. Meta, their example of, they have monopoly in social networking companies. Procter & Gamble, example of something Kramer like, and I like it too because they have consistent, people are going to be buying Tide and Gillette 10 years, 20 years from now. And they're reducing their products over time. That's a good business model. General Electric, I'm surprised you would buy this. This is all they sell right now. They spun off a bunch of companies. All they sell is aerospace engines and stuff like that right now. So I don't understand that company anymore. ServiceNow, that's pretty expensive. But whenever the stock market sells off, the companies like Microsoft, Waste Management, Meta, Apple, Google, they're all going to hold up better because they're not, there's not as many soft hands. People are going to sell them really easily. There's a lot of mutual funds holding them. So anyways, I thought that was interesting to go through all that today. I think I've exceeded my time. I hope I didn't scare any of the new people off. Thank you very much for attending. If I can answer any questions for you during the week, let me know. And if you want me to review your portfolio, if you have any questions about any of this, let me know. And next week we'll go over portfolios, how to put together a portfolio and how to dollar cost, how to basically buy and hold and do your homework over time in different situations for different risk profiles. All right. Well, thanks again. I hope to see you next time.
Thanks, Greg.
Okay. Thank you.
All right. Thanks. See you.